What if I told you that last week wasn't just another week for mortgage market, it was a complete game changer. The US election flipped Washington red with a Republican sweep shaking up expectations for economic policy. And just 2 days later, the Fed cut rates by 25 basis points. Despite all this, the mortgage rates have been on a roller coaster ride. So, why did mortgage rates end the week lower, and how should you navigate the upcoming week's market? Let's break it all down. In last week's video, I broke down how a Trump or Harris win could affect mortgage rates. If you missed it, check it out. I will also leave a link in the description below. Now, let's shift gears and look at what's next for mortgage rates. But first, let's quickly review last week, a week filled with political drama, economic surprises, and major market moves. Between the US election, a Republican sweep, and a Fed rate cut, and several record-setting economic data releases, a lot happened that's shaping where we start this week. Then we'll explore the major economic data and events that could impact the mortgage rates in days to come. So let's dive right in. Let's take a closer look at what happened last week with mortgage rates and the broader market trends. The week started on Monday, November the 4th, with mortgage rates slightly lower at 7.05%. This drop came after a weekend of unexpected volatility that worked in favor of lower rates. Key election polls showed Vice President Kamala Harris holding an edge over Donald Trump, which eased market fears and led to a drop in Treasury yields. In fact, the 10-year US Treasury yield fell by 5.2 basis points down to 4.309%, marking its largest one-day drop since early October. On Tuesday, Election Day, mortgage rates edged just a bit lower to 7.04%, and markets were in a holding pattern waiting for election results. Earlier in the day, stronger than expected ISM data pushed bond yields higher, creating some upward pressure. But overall, uncertainty around the election outcome kept volatility in check through most of the day. Then came Wednesday, November 6th, and everything shifted. By late Tuesday night, it was clear that Donald Trump had won the presidency, along with strong Republican control in Congress. This certainty rattled bond markets, causing the 10-year Treasury yield to spike sharply higher. As a result, mortgage rates jumped to 7.13%, reflecting market expectations of pro-growth, potentially inflationary policies under Republican leadership. Thursday brought a mix of economic data that helped ease some pressure on rates ahead of Fed's big announcement. Jobless claims came in at 221,000, just above the forecast of 220,000 and prior week's 218,000. This slight increase wasn't alarming and signaled continued stability in the labor market. The preliminary Q3 productivity report showed growth at 2.2%, below expected 2.5%, but slightly better than the previous quarter's 2.1%. This weaker than expected number hinted a moderate economic growth, helping to lower Treasury yields. And finally, wholesale inventories for September dropped by 0.2%, more than the expected minus 0.1%, and a sharp reversal from previous plus 0.1%. This larger decline signaled soft demand, which the market interpreted as cooling economic momentum. These reports collectively pulled the 10-year US Treasury yield lower, and by the end of the day, mortgage rates had dipped down to 6.98%, the lowest level of the week. This was even before the Fed had even announced its widely expected 25 basis point rate cut, which had already been priced in by the markets. And then finally on Friday, November the 8th, the week ended with a calmer note. The preliminary consumer sentiment report for November came in at 73, beating expectations of 71 and the prior reading of 70.5. This slight improvement added a bit more downward pressure on yields and rates. By the end of the day, the average 30-year mortgage had settled at 6.92%. The combination of Republican control in the government and the classic buy the rumor, sell the news dynamic helped rates finish lower despite all the volatility earlier in the week. So, what's the takeaway? Well, last week was a perfect storm of political shifts, economic data, and central bank action. It showed just how sensitive mortgage rates are to major events. Rates started the week at 7.05%, peaked midweek at 7.13%, and ultimately settled at 6.92%, a roller coaster ride driven by a mix of political certainty and cooling inflation fears. Now, let's talk about the major economic data and events that could shape the mortgage rates in coming days. We start the week quietly on Monday as it's Veterans Day and the bond market is closed. That means no action on treasury yields or rates, but things pick up quickly after that. On Tuesday, November the 12th, we'll get NFIB, Small Business Optimism Index for October. This report gives us a sense of how small businesses are feeling about the economy. The forecast is 92, slightly above last month's 91.5. If it beats expectation, it could signal stronger business confidence, usually a sign of economic resilience. That kind of optimism tends to push interest rates higher. On the other hand, if the number falls short, it could be a sign of a softness in the economy, which might keep rates stable or even push them lower. Moving to Wednesday, November the 13th, we'll see the Consumer Price Index or CPI for October. And this is the week's headline event. CPI measures inflation, which is one of the most significant factors affecting the Fed's monetary policy, and by extension, mortgage rates. The monthly forecast is plus 0.2% with year-over-year CPI at 2.5% and core CPI holding at 3.3%. If inflation comes in hotter than expected, it could trigger concerns about the Fed needing to remain aggressive, which might push rates higher. But if CPI matches or even underperforms the forecast, we could see some relief in treasury yields, which would help keep mortgage rates steady or moving lower. Then on Thursday, November the 14th, we'll get two reports: the Producer Price Index (PPI) and the initial jobless claims. PPI measures inflation at the producer level and is forecast at plus 0.2% for the headline number, with year-over-year core PPI expected at 3.2%. If PPI numbers are stronger than forecast, it could ignite inflation concerns, putting upward pressure on rates. Meanwhile, jobless claims are projected to come in at 225,000, just a bit higher than the previous week's 221,000. This indicates a steady labor market, which markets usually interpret as a sign of economic stability. Finally, Friday, November the 15th wraps the week up with a range of data including retail sales for October. Retail sales are forecasted to rise by 0.3%, with sales minus auto also expected to grow at 0.3%. These numbers give us a good sense of consumer spending, which drives a large part of US economy. A strong report could push rates higher, while weaker sales might ease some of the pressure. Altogether, this week's events are balancing act for the market. The focus will be on inflation data like the CPI and PPI, along with signs of consumer strength from retail sales. If we see higher than expected inflation or strong retail numbers, mortgage rates could face upward pressure. But if the data shows moderation, it could continue the downward trend we saw at the end of this week. So, what does all of this mean if you're looking to buy a home or refinance your mortgage? Here's what you should keep in mind as we head into this upcoming week. First, let's talk about locking in a rate. If inflation data this week, like the CPI or PPI, comes in higher than expected, it could push mortgage rates higher. And with the market still processing last week's Fed rate cut and the Republican victory, there is a potential for volatility. Hence, locking in your rate now could be a smart move to protect yourself from any sudden spikes. On the other hand, if you are comfortable with a bit of risk, there is a case to be made to wait. If inflation shows signs of cooling or retail sales come in weaker than expected, we could see mortgage rates continue their downward trend, giving you a better deal later in the week or even in coming weeks. However, this approach does come with the risk that rates could unexpectedly rise, so it's important to weigh that carefully. This week is packed with crucial economic reports that could shift the mortgage markets in a meaningful manner. Whether you are a home buyer or refinancer or just keeping an eye on the market, staying informed will help you make the best financial decision for yourself. If you found this video helpful, please consider liking and subscribing to the channel and turn on notifications so you never miss an update. I'll be here to break down the numbers and explain what they mean for your wallet. And let me know in the comments, what do you think? Will rates keep falling or are we in for another jump? I'd love to hear your thoughts in the comments and answer any questions you might have. Thanks for watching and I'll see you next time.